Hey, everybody, welcome to tonight's live stream. I thought I'd surprise everybody and try to go live. And you may have noticed that it wasn't working all that well. So I've noticed that one of the programs that I use to go live, the permissions weren't enabled and so on. I'm just going to try winging it tonight. There'll be no slides. If you have any questions at all, please put your comments below. Type them in, and I'll gladly reply to them as we go through them. We're going to be talking about 5 retirement mistakes that I see quite often, and I'm going to share those 5 with you with no slides. So it's just going to be me talking, and then also if you have any other topics you want me to talk about, I'm happy to do that. But we're going to get into the 5 retirement mistakes and how you can correct them as you go through your retirement. So the first one, and by the way, I hope you're all doing well. Thanks for all your support. Remember to just put your comments below, and let's get into it. So the first one is not having a plan. You know, I talk to you guys all the time about this. Just about in every video, I say you've got to have a retirement plan or a financial plan, whatever you want to describe it or label it. You have to have one. People ask me all the time, when should I get a plan? And the answer is the moment you put $1 into an investment or a retirement portfolio, that's when you should start to develop your retirement plan, is understanding what is the reason why you're putting money into these plans, whether it's an RSP, TFSA, why are you participating in your company's group plan? All these different things. Why do you have a trading account? All these things, you want to know what is the reason. And what you do is you get a financial plan done that will show you what is the projection, if you will, of this saving strategy. If you continue to do what you're going to be doing, how much money you're going to have at the end of the rainbow, right? So you want to understand that. And more importantly, is what you're doing is actually going to be sufficient. Is the other reason, of course, is you need to have a plan. That's just one. And then the next is taxation. What you're doing right now, is that going to make your life really miserable? For you young people that are watching, I know I don't get a lot of young people because a lot of the content I'm providing is for people my age and older. But you're going to be really disappointed if you get to retirement and all you ever did was put money into one type of investment account that drives your tax rate up. You're going to be really unhappy about that. So I would encourage you to get a plan done as soon as possible. So that's the first thing. Okay. Number 2, taking CPP early. Many of you ask, is CPP part of the kind of plans that we do? And the answer is yes. CPP optimization is in all of the retirement plans that we do. And understanding when to take CPP and old age security is actually very critical to your retirement. So I want you to think of your CPP and old age security. I want you to think of your plan of having 3 levers, okay? Like a dimmer switch, if you're familiar with a dimmer switch. And so the first dimmer switch, if you will, to your retirement plan is your government benefits, CPP and old age security. So you're dialing this dimmer switch as to when you should take it early, take it late, trying to understand what is the optimal age for you to use your government benefits and when to start taking that. The second dimmer switch or lever is your effective tax rate. How much money are you paying in taxes throughout your entire life from today until when you pass away? So that's the second dimmer switch. And then the third dimmer switch or lever is really your withdrawal rate. How much money you're taking out of these accounts that you're investing in? What are the other sources of income that you have available to you? And so you start moving these dimmer switches around to get the optimal range, so you get the highest income with the lowest tax rate. Okay, so that's why understanding if you take CPP too early, it may not be beneficial for you. You may have just taken a lot of money off the table. So you want to understand what is the optimal time for you to do that. I have a question here. What if you contribute and invest in high risk investments? Oh no, I think that's first time home saving account. Okay, we'll get to that in a second. Number 3, years, not decades. I want you to think of retirement in terms of decades, not in terms of years. The average couple, now this is important to know actually as well, is that statistically couples live longer than single people in retirement. Not to bash on you single people, but It's just a statistic. I don't know. I think it's more about, this having this shared purpose throughout retirement. I know that being married to my wife for nearly 30 years now, the one thing that is very comforting is, she's my absolute best friend. And I know that when I'm not feeling my most positive self, she's there to support me and I'm there to support her. We're there experiencing and sharing life together. And I think that's something about being more emotionally connected to life and to another person. And for some reason, it translates to longer longevity. So there is some merit in being married in retirement. If you are so here's some statistics. If you're 65 years of age today, women, you have about a 72% chance of living till age 85. For men, if you're 65 years of age today, you have a 63% chance of making it to age 85. So there's some good statistics that there's at least 20 more years for people who are 65 today that they're going to be living. The average person lives, now depending on when you start retirement, will live between 25 to 28 years in retirement. So you got to start thinking about decades. And then the other part of it is you also have to be considering about how healthy you're going to be in those decades. So the first decade, that's why we have phased income, where you have higher income early in life, and then we step down that income. I call it phase down that income as you get older. Now, some of you, that income might phase back up again because of medical expenses and having to have care. My last video, I think I talked about in that example of having somebody come in to care for somebody, about $33,000 a year. Windsor Roads, I'm 44 and watch your content. Thanks very much. Appreciate your support. I love reading your comments, guys. So please continue to do so. Okay. The fourth one. How am I doing on time? 7 minutes. I'm going to do a really good video, short video, for those of you who want me to get to the point. Eggs in one basket. Now, this is really about diversification of your portfolio, diversification of account types. So let me explain diversification of your portfolio. People tend to, when I do portfolio reviews, first, they're not clear on what they're invested in. So the first thing I got to get you to do when you're a client of mine is educate you on how you're invested today, whether or not I'm just doing a plan and you share with me your investments, and then I'm going to help you to understand what you're invested in, give you recommendations as to what might be better for you, more suitable for you. But by the time you're done learning about that, you should be able to bang out exactly how you're invested so easily. You may not know all the things about what you're invested, but you should know enough to know how that's going to be useful for you in your portfolio to give you the kind of return risk profile and then the income you're going to use in retirement. So the first thing you want to know about your portfolio is, do you understand enough to be confident that it's the right thing for you? So that's the first thing. So it takes a little bit of time, takes the right person, maybe the right advisor, to teach you a little bit, to give you some time to say, look, here's what you're invested in. Let's explore what this means. Don't worry about stupid questions. Just let's get to a point where you feel really confident and to not worry about what kind of question it is. Once you get an understanding of your portfolio, then you say, okay, now I understand how this works. Should I invest in an RSP? Should I be investing in TFSA? How does a LIRA work? When does the income start? Can I unlock the LIRA? How does that work? Where does the money go? What is an RSP meltdown? What's a RIF meltdown? How does that benefit me? Why should I do a deferral of my CPP? When you start to understand these things about your portfolio, you start realizing the whole world opens up for you in terms of now what is possible, and what you didn't quite understand before. Now you actually are interested to learn more because you now see the value of that type of investment, how useful it might be to you. I see a lot of you invested in one balance fund, for instance, and that is problematic in the sense that you want to make sure that your money is well diversified. I'm a little bit a believer, if you will, of having individual positions rather than a one balanced fund. There are reasons why you might choose a balanced fund. I won't get into all those reasons, but what I like to do is have individual positions. That way, let's say, for instance, let's say US is out of favor right now and you're in a balanced fund. Well, the only way to rotate your portfolio and to get less US weighting in your portfolio is to sell the balanced fund, because it's all connected. US, international, Canada is all connected in the balanced fund, most likely. And so if you have individual positions, meaning an individual US equity fund, an individual Canadian equity, individual international fund, some specialty funds, then as things become out of favor, so especially as we saw interest rates are changing now, we started looking at fixed income versus equity, you can start rotating the balances out of your portfolio. This is what you'll hear advisors talking about, rebalancing your portfolio. Some things have gone up in value too much, and you're trying to rebalance those into different positions. So understanding that having a one balance fund may not be appropriate for you, and you'd want to have individual positions. So that's a little bit about portfolio diversification, and meaning you have your money spread across different positions. Now, there is some math behind having too many positions. If you have more than 30 positions, chances are adding more, it's not chances, I actually have a video on this if you go on my YouTube channel, that as you add more positions to your portfolio, it does not increase, it doesn't guarantee that you're going to make more money, and it doesn't lower your risk by adding more positions. More people think that by adding more positions is actually lowering your risk. It doesn't really lower your risk, because if they're in the same category, then they're not really lowering. Like if you're buying more technology positions, you're not lowering your risk. You've actually increased your risk. So that's a little bit about diversification. Now, the second thing about eggs in one basket goes back to your assets in account types. So when you have all your money in an RSP and nothing really in a TFSA account, for whatever reason, maybe you took money out of your TFSA to fund a purchase and you just didn't put it back, then when you get to retirement, your tax rate's actually going to be quite high, because all the money you need and have to get access to comes at a really high tax rate, because the more you pull out, the higher tax rate goes up. So the advantages of starting a financial plan much earlier in life is understanding what your withdrawal sequences are going to be like in retirement. So you can say, okay, I'm going to have so much in an RSP, so much in my group plan that's going to be part of an RSP, part of a LIRA, so much in a tax-free savings account, so much in a non-registered account, so you can understand what your withdrawals are going to look like in retirement. So having all your money, having 1 million, 2 million, 3 million, all in an RSP account, yeah, you're going to have enough money to retire, but it's going to come to be an expensive retirement for you. Question here. Rosemary, how are you doing, Rosemary? Hope all is well. Let's see here. David, what is your favorite thoughts on the stock market trend now that interest rates is coming down? Okay, Rosemary, that's a great question. Did I just do the heart? I guess I can heart that, can't I? Isn't that interesting? What is my thoughts on interest rates coming down? Well, when interest rates are lower, asset prices go up. So I want you to think free money. Think back when interest rates were nearly zero. Everybody was doing mortgages, not just on their own home, but they were also getting into the real estate market. And what did we see about real estate prices? You know, if you talk about that, Trudeau's government has created an immigration crisis, and that immigration crisis has led to a lack of housing and supply. That's probably true in that regard. But low interest rates, free money, made it easy for people to invest in real estate, and that also drove up real estate prices. So inflation has been a sore spot for many people, and especially for fixed income seniors who are living on GIS, so guaranteed income supplement, means their income is less than $21,000 a year. They have found this period of inflation brutally devastating for them. For those of you who aren't suffering for money and who have good incomes, and you complain about the price of milk and eggs and bread and meat and cheese and all these things, and you suffer through it because you have enough money to do it, the seniors who are living on $21,000 a year, they're buying 6 eggs, not a dozen eggs. They're buying pieces of chicken. They're buying 1 or 2 slices of fish that you buy independently. And it's very, very hard for them. So inflation is coming down, and we see interest rates coming down. So here's what I fear, Rosemary, about interest rates coming down. It's going to help people who have been in variable rate mortgages, that they're finally going to get some relief. That's very useful because, we're worried about delinquency in mortgages in Canada. We're worried about people declaring bankruptcy because of these kinds of things. Sudden selling of real estate because people can no longer carry their mortgages on these real estate is going to vastly affect the real estate market. We saw with interest rates being so high that the condo market in Toronto was devastated, right? People are losing money. People are selling their condos for less, trying to get out of condos because of that. So interest rates coming down are useful. That is going to be a relief to those kinds of people. What I fear about interest rates coming down is that nobody is going to have learned a lesson, and everybody's going to go back to borrowing money at low rates, and that's going to create another real estate bubble. So what I'm most concerned about interest rates coming down is this real estate bubble is going to continue. It's so hard for young people to get into a home today. If you was having a conversation with a client yesterday, in fact, and talking about your young kids that are graduating university, and you say to them that you're so proud that they got a starting salary of $85,000. It would be remarkable for just a first year entry level position in any company. And forget about being a doctor or a lawyer or anything like that. Just you'd be really proud of your kids getting that kind of income, and yet they can't do anything with that. They can't purchase a home. It's not enough money in the GTA to purchase a home, which is terribly, terribly devastating for someone who's making $85,000 that can't own their own home. They're going to have to rent for a long time, or they're going to have to do it old-fashioned way, and that's get a couple people together to buy a home and renovate it and flip it and that kind of thing. So, of course, having not enough money creates optimism. People start thinking creatively about how to get what they're doing. But so I think that interest rates have to come down. They should have come down a long time ago, but I think that it's going to just create a worse situation in Canada for real estate. This is my biggest fear. And my hope is that under a new government next year, that there'll be some changes about how real estate is being developed in Canada, so that we can get more supply on the market, so that it doesn't cost so much money for young couples to start their first home. That dream, and right now, is killed. There's no question about it. But that's my biggest fear about interest rates. I'm more concerned, Rosemary, if you want to go about interest rates, I'm more concerned in the short term about the U.S. election than I am of interest rates. I'm more concerned about the next 2 months. So on a short-term basis, I'm more worried about what will be the outcome of the United States election. And so statistically, not that I'm going to tell you who I'm going to favor, I'm just telling you the statistics, that statistically the stock market in the US is positive in the year of an election cycle. So right now, and we see that, and it's positive the year after a Republican wins the presidency, and negative a year after a Democrat wins the presidency. You can say that as you draw your own conclusions. And I'm just saying that's the statistics. So I'm more concerned about the short term right now. Interest rates are important. We see the trajectory of those things coming down, but I'm more worried about, who's going to win the presidency. And as soon as we have that out of the way, then we can start looking at longer term projections. Okay, the fifth reason, or do we have another question? How was that, Rosemary? Was that a good answer? Hey, Phil, good to see you. Thanks for dropping by tonight. Good to see you. And I will fix this problem with the software so that I can put up slides and show you all these great pieces of software. Portfolio gains is number 5, or not gains, goals. So the fifth mistake that people are making with their portfolios is just really around not having any goals with your portfolio. So I went on, it was kind of like number 4, eggs in one basket. But if I were to ask you a moment to reflect on your own portfolio, how did you put together? This is something I ask nearly everybody I talk to, okay? You give me your portfolio, I'm doing a portfolio review. And before I give you any information, I say to you, tell me, how did you put this portfolio together? And I just wait for your answer, because most of the time it's kind of put together like patchwork, like a quilt. You got excited about this stock over here, or this mutual fund, or whatever, this investment, you got excited about that. You heard a tip on this and you ended up buying that. Something that you always wanted to buy dropped and you bought it, and you've held it for a long time, but it's kind of like an odd thing in your portfolio. It doesn't quite fit the rest of your portfolio. You may be way overexposed in some areas of your portfolio. You may have seen over this year that the Magnificent Seven has blown up your portfolio greatly in the technology space, and so you're overweighted in technology, which has some risk to it, obviously. So you really do want to build your portfolio around some kind of strategy. So you're thinking about, if I go back to doing a financial plan and retirement plan, the method and the madness of doing a financial plan is understanding what is the return expectation that you need for your financial plan today all the way through retirement. And understanding what that profile is for you for a return helps you to understand then what you can invest in, or what you ought to invest in for the majority of your money, so that you can be assured that your money is going to supply you with the income stream throughout your retirement. The danger is chasing after, these different things, the new shiny penny, is that it's kind of like an abstract kind of portfolio, and it's really difficult to plan because the returns are all over the map. And so it's very hard as an advisor, or even for yourself, to gauge what kind of income you're going to get out of your portfolio, given the sort of volatility in terms of return. That's hard to do. So what I'd prefer you do is do a financial plan, get a return profile that says you need to get at least this minimum return expectation to have all of your lifestyle goals be met. And then anything above that is your own risk, how much you want to take on to acquire more money. But I think the moment you have that return profile developed, then that helps you to figure out exactly what to invest in. And you actually are more quieter about your retirement. You don't have to worry about the noise about you should invest here and you should invest here. You know that your retirement is sound, and it's pretty easy to live in that regard. So first thing is, I would say for number 5, understand what is the purpose of your portfolio, what is the goals of your portfolio, and then purchase or invest in securities that are going to meet that need. Anything else, if you take 5 or 10% of your portfolio and chase after some exciting things, go for it. I often say to people, if you have a professional money manager, I manage money for my clients, give them your retirement assets, let them do the professional money management. But then if you do have your own kind of investment account that you want to pick and choose some stocks because it's exciting and you want to be in the game, so take 5 or 10% of your money and do that, because that's not going to really affect your retirement. So if you want to do that, go after some of those, I don't want to say speculation, but still be excited about those positions that you like. Okay. Harvey, what are you asking me? Let's see here. Well, I'm using Snap. I must have said it a few times. So does Snap allow, so for those of you who don't understand the question, Snap Projections is the software that I use. I actually have 3 software programs, depending on the complexity of my clients. Snap, for about 98% of you, will be awesome. I've used Razor Plan. Razor Plan is a good plan. I don't want to knock Razor Plan because they're a good company, Canadian company, but has its limitations with doing real estate and so on. Snap, I think, does a better job visually of how things work out, and I think clients are more familiar because it kind of looks like an Excel spreadsheet, and most people are familiar with Excel spreadsheets. The great thing about Snap is we can play around, is the taxation module in Snap. You get to really be able to manipulate the tax rates in Snap to really model the real life situation that you're going through. So it's not just about the RRIF meltdown and trying to get the capital gains to look the proper way. We can actually go into the back end and change the tax rates so that we can give you tax deductions, for instance. So that's very useful, especially when you're doing, let's say, first-time home buyers plan. When someone's taking money over an RSP, we can go into the back end and give them a tax credit to help model the way that money comes out of your RSP on a tax-free basis. So yes, Harvey, Snap is really good for that kind of modeling. Actually like Snap for non-registered accounts as well because of that very reason. So whoever you're using, get them to dig into the plan and work it to exactly the way you want. Common law, I'm not sure, Dave, if you're asking me, do I do income splitting with spouses in plans? Typically, so Snap Projections allows, now it sounds like I'm doing a sales thing for Snap Projections. Snap allows us to, there's a setting that we can toggle on and off in Snap Projections to allow income splitting or not. And so most often, for most of you who are couples, most of you want to show income splitting in those plans, and it's automatic. I'd love to tell you that, we are all these geniuses with our slide rulers out there. I guess I'm showing my age by saying slide ruler, but Snap is actually doing all that heavy lifting for us. The moment that I put in your assets and your pension plans and so on, and your age and retirement age, bang, Snap does the income splitting. The only thing I have to be aware of is if you don't want it, and I have to ask those questions because many people aren't even aware about income splitting. And so we have to make you aware that this is what's going on, and are you filing your income tax that way? But yeah, Dave, in all of my plans, unless you tell me otherwise, we're doing income splitting in the plans. I wish I could show you. I'm not sure how to do that right now, but I wish I could show you. I think I can do screen sharing, but I'm afraid I don't know what it's going to do. Magnificent 7 stocks in TFSA. So I'm not going to talk about what stocks you should put here or there and which accounts, because that's not what my channel does. I don't talk about an individual stock. All I can tell you is whether or not you put all the I think I know what you're going by here in terms of whether or not you can claim a capital gains or capital loss. Is that what you're really going by? Is pro guy 2? I think that's what you're kind of hinting at, aren't you? Or is it really about US stocks in a TFSA account? I don't want to get into that because that's not what my job is in terms of planning. And but I would tell you this: you have to be aware of your weighting in your positions in your portfolio. The Magnificent 7 stocks have gone up dramatically. And in 2022, I think it was, they went down dramatically. If you may recall, the NASDAQ went up 43% and then down 36% the next year after that. So you want to be aware of how the Magnificent 7 have ballooned your portfolio. Now, I'm a big believer in technology. In fact, with many of my portfolios are through RBC, and the US equity fund is led by technology. Most funds are led by financial services and then technology. RBC's U.S. equity fund is technology driven. So I love the fact that's number one on the list. So you just got to be aware of what your weighting is in your positions. That's the only thing I would say is that's the hard thing about buying. When I go back to, I think it was eggs in one basket and diversification and so on. If you have a balanced fund and that balanced fund has a high technology weighting in it, and so now the technology is gone up dramatically in that fund, you hope that that fund is automatic rebalancing for you, so that it should automatically rebalance throughout the year for you. Usually you see it being rebalanced. What I like to do, as I said before, is have individual positions. So I have to do the rebalancing for my clients because they're individual positions. So if I have a high weighting in technology in one position, by the end of the year in the new year when I'm doing rebalancing, I'm going to have to shift some money around to make sure that we're always keeping the kind of equity to fixed income in someone's portfolio. But that's about it. Well, that's it, guys. You know what? It's been half an hour. You got another question for me? Okay, Brad, I'll stick around. Can you keep an RSP account active while converting one to RIF? Yeah, you can have different account. Well, okay. Let me stop for a second. The moment you hit 71, everything's got to convert to a RIF. So that's the answer to that question quickly. One of the strategies is before age 71, let's say I did a large RSP account. Let's say I had $1 million. And you didn't need all of your money. If you were to RIF all of that right now, you would be getting an income stream, in this example, that is above your needs. So you're going to pay tax on this gross amount coming out of your RIF that you're going to have to pay income tax on, and it's income that you're not spending. So you say, well, why should I take money out of my RSP and pay tax on money that I'm not spending? So the idea would be to have two RSP accounts. One in the amount that when you calculate what the RIF would come out of that meets your need, and leave the other RSP to alone. And so the RIF account is still going to defer growth of what you're not taking out, but the money coming out of the RIF is really what you're concentrating and focusing on. So you want to just have the one RSP account riffing to the extent of what income you need, and leave the other RSP accounts alone until such time that you need them, or until you hit age 71 where you need to withdraw. Now, you don't have to withdraw right away. You have to withdraw before your age 72. So you can defer it almost 12 months. But that's a good question. Many people don't bother to do that because many people don't have RSP accounts that are high enough that by the time they've got to retirement, they actually need all their money. And it's kind of interesting, but that's a great question. It's insightful. It tells me you know a little bit about how much money you need in retirement. 65 using on RIF and another keep an RSP. Okay. Let me just expand on that just for a second, Brad. What you want to do there is not just focus on your income need, but you want to focus on the idea that if you waited too long to start drawing money out of the second, so let's say you have two, in your example, Brad, let's say you have two RSP accounts. One, you are either doing an RSP meltdown, so you're not riffing it, you're just doing an RSP meltdown. But it sounds to me like you want to riff that account. So you riff the one account and then you leave the second RSP account alone. The danger, and this is what you have to watch out for, is that if you leave it too old of an age, let's say you don't do anything till age 71, and the balance in the second account is high, then what you're going to see, the minimum with RIF withdrawal is going to be actually a big number. And then you start looking, at least in my software, you start looking over to the left and you start seeing this huge effective tax rate, and you start seeing a clawback in your old age security, and you go, wait a minute, maybe I should have started taking money out of that second RSP a little bit earlier. So the only thing I would say about that strategy, Brad, is to just go another step further and say, well, if I do that, will these things occur if I wait too long? So that's what a financial plan, some people try to build Excel spreadsheets to see if they can calculate the RIF, and then the tax rate and the clawback and old age security. This will not work for you, Brad, if you've got a pension plan. If any of you have a defined benefit plan and you're getting $40,000, $50,000, and some of you are getting $80,000, $90,000, $100,000 when you're much older in life, and you're deferring your CPP to the very end because you said, "Oh, I got all this pension. I don't want to take my my RSP. I'm going to defer it till 70, and then I'll take it." Man, you are getting smashed with tax so badly when you're 80 and 90 years of age. I mean, it's a bad scene. So you really want to focus on your withdrawal strategy earlier. So Dave, great question. So RSP over 1 million should do an RSP meltdown. Just like as a quick answer, yeah. I mean, if you've got $1 million and you're 60, let's say, and just look at, you can go to this, I'm not going to type it on the screen. It's called 𝗪𝗵𝘆 It's a Canadian website. It's sponsored by the Ontario Securities Commission. And so there's no advertisements. What I like about it, there's nobody trying to sell anything. It's solely unbiased. But they've got this calculator. You go to 𝗪𝗵𝘆 and go to tools, calculators, RIF withdrawal. And the RIF withdrawal is on the second page. Yeah, I've been there a few times. And so you're going to punch in your numbers. And what you'll see is if you punch in your age and you put in $1 million and then put an expected rate of return. Now, it doesn't let you do two rates of return, like a higher rate of return the first 10 or 15 years and a lower rate of return when you're older, when your risk tolerance is a little bit lower. It's just going to give you one static rate of return. So just put in a number that you feel comfortable. And what you're going to find, and then when you hit go or start or whatever the button says, expand the table so it goes to all rows and go right to the bottom of the table, and you'll see how much money you have at the end of your life. So you also have to put in your expected mortality, right? And what you're going to find, Dave, is you're going to have money left over. And then all you have to do is go to EY Canada. Man, I'm plugging all these companies, right? Go to EY Canada's got a tax table for you, and you just go to 2024. If you Google EY Canada income tax, and it'll give you another tool to put in. You're just going to put in the value of your RIF at the year that you pass. So let's say, Dave, you've got $1 million now, and when you pass, you have $500,000. Then take $500,000 and drop it in that EY tax calculator and hit go, and it'll tell you how much money, which is going to be 53%. Your marginal tax rate will be 53%. So having a high RSP balance at 60, like $1 million, is you've got to start to melt it down. And it becomes more complex. I talk in some of the videos about like it's a puzzle, right? Having to try to understand CPP and old age security, having a pension plan, private pension plan, having RSP, TFSA, LIRAs, LRIFs, all these taxable accounts is really the piece of the puzzle that you're trying to put together. And you really need to have a financial plan to help you to do that. Most people can get close to the number. Actually, Canada Revenue, yeah, has a website. It's their retirement planning tool. It actually is not bad. I have a video on it. So you could put in your information and it'll calculate, it'll put in your age and so on, and it'll tell you your CPP and your old age security, how much you're expected to get. Then put in your RSP balance, and when you plan to actually start taking that as an income, and then all of a sudden the graph goes up another notch, and it'll give you your expected income and how long it'll last throughout retirement, how much tax you'll pay. So it's actually not a bad planning tool if you don't want to pay the money to get a financial plan. That's a pretty good place to start. Those three websites: GetSmarterAboutMoney.ca, EY Canada for their tax calculator, and then the CRA's retirement planning tool. And you should be close. But I always encourage people to get a proper plan done. Okay, I think I'm going to call it quits to tonight's live stream. I don't have anything else to talk to you about. I mean, I have 1,000 things I could talk to you about, but it's not going to be an abstract night. And I'm going to just say good evening. Hope you're all doing well. I want to go back to live streaming as soon as I figure out what's the problem with the software. That I think it's the permissions are not set properly to allow me to stream across all the platforms. So as you saw earlier, how I tried to go live and it's like, what is going on with this? But hey, great to see you all. Thanks for supporting my channel. And I look forward to seeing you in the next video. Thanks and be well. All the best.